Hi traders, welcome to Tuesday. Welcome to the Flow Show. Good morning, Kay. Good morning, Stell.
Morning, everybody.
Morning. How are we all doing? Oh,
we're all full of energy today, aren't we?
I just say, sound like a cheerful bunch. Cool, blimey. You need a gin in you or something. Get you through the day.
Yeah.
Well, must be the January blues, eh?
Yeah, after 2 weeks of holidays, or almost 2 weeks, it's difficult to get back to the normality, let's say, but it's okay.
It's okay.
We do it year in, year out.
Exactly. Have you got rid of your kids yet? Are they back at school?
Yes, sir. They popped open the champagne yesterday.
It didn't last long by the sounds of it.
Yeah.
Right, let's get stuck into it, because these two cheery chaps are going to be entertaining us today, but it doesn't seem. Anyway, China, they are said to looking at cutting their VAT among small businesses until December this year, part of further measures to try and kickstart the economy post pandemic, or even though we're still in the midst of it. It's quite funny because they are still doing quite sizable easing measures on the fiscal front, and yet the yuan is gaining significantly, and the market is looking at this like it's going to be positive for Chinese growth. A few banks are revising up their forecast for GDP for the next year or so. So quite different to other countries, where if you get a bout of easing, we're more worried about what the recession is going to be like. You know, that's what we're facing over here. But if they're continuing to ease in China, the market sees it as long-term benefits to come. We shall see. The Chinese ambassador to Australia says hopes both countries will return to normal trade relationships. So again, potentially more easing there in those hostilities. But China has suspended visa issuance to Japanese travellers, according to Kyodo. This is a bit of a response to countries who are placing restrictions on Chinese folks coming into their countries due to the COVID wave. So a bit of tit for tat there, rather than anything too bad. Speaking of Japan, some data overnight, strong inflation data for Tokyo. CPI coming in at 4% versus 3.7%. Core CPI 4% versus 3.8 expected and 3.6 prior. So still strong numbers on the inflation front coming out from Japan. Not too much of a move that I saw in the yen overnight on those numbers. Just to counter the inflation news there, household spending year on year dropped 1.2% versus 0.5 expected. On the month was worse as well, down 0.9%. Could be a bit of a time of year thing, seasonal thing. Hard to get a read these November, December months, but on the face of it, not good numbers there at all. Coming over to the EU and the Brexit shenanigans that we've been speaking about. It seems that the UK and EU have reached an agreement regarding the EU having access to UK IT systems and database sharing, data sharing for the movement of trade. This is something they have actually been trialing and working on for the last few months. We heard about that late last year, but it seems it's coming towards an agreement. As mentioned, it's looking likely that something's going to be done. I don't think there's going to be much market impact for the pound outside of maybe a small knee jerk, if and when things are fully confirmed. And while we stay in the UK, some overnight retail sales data, some small data from British Retail Consortium, saying that like-for-like sales for December were up 6.5% versus the prior 4.1%. So potentially showing that retail sales in the UK for December were fairly positive, and obviously we'll see that in the main numbers coming up soon. BOE's Peel says the rise in policy rates to current levels can be seen as significant progress in the normalisation of monetary policy. The BOE will continue to act to reach its inflation target, and the MPC will respond forcefully if needed. We do have this Riksbank thing going on at the moment. There's not been anything of real note out so far. But keep an eye on that. I'm keeping an eye on the headlines in case anything does pop up. Over to the US, and the New York Fed inflation measure showed that short-term inflation expectations continue to decline, although there was a tick up in the longer-term inflation forecasts or expectations. Fed's daily said overall inflation is coming down, but it's mostly in energy and goods, and that they're seeing more persistence in aspects of inflation being tough to get down. So a little bit of a nod to the difference between energy type inflation and the fast stuff, and things like the core, where it's feeding through into other areas. She said December wage data was 1 month of data, and that they cannot declare victory and stop rate hikes. It would be reasonable for rates to be in the 5 to 5.25% mark, and she says that 50 or 25 BPs are on the table for the next policy meeting. That's about it from the headline front. Guys, you got anything you want to comment on that Japanese data or anything else you've seen?
Well, yeah, we've got to know that Tokyo is about what, 25-30% or so of Japanese economy. It came out higher, but then, as you say, it was countered by those very weak household data, and those are the ones that really are going to need to see a pickup, in my opinion, to really get a lot more positive on Japan, for what I'm concerned. Now, for the rest, not much outright. Yeah, a bit Norwegian CPI. We're seeing roughly the same thing as happening elsewhere. The headline coming off, but then the core being a bit stubborn. But it didn't benefit the Norwegian kroner at all this morning. On the contrary, we're trading a little higher in the euro NOK, likely also because Brent, which saw a little bit of a run, is coming back down below $80 right now. So yeah, the Norwegian kroner is still on the defensive. But then for the rest, headline-wise, apart from people shedding more jobs, not seeing much, apart from some opinion pieces. You know, this morning Goldman saying that they are pretty positive on Europe, the GDP. They are seeing they don't see it in contraction in 2023. For the rest, nothing really major in the headlines. It's more for what's to come, earnings and CPI, and then this afternoon, Mr. Powell. So yeah, the market is clearly in a wait and see mode right now. Stuff is moving a little bit just because of volatility, but it's not making any headway anywhere really.
Yeah, no, I agree with that, mate. Stel, what do you make of it at the moment? We're just treading water a bit.
Yeah, well, first of all, haven't seen anything more than what you said, data-wise and news-wise. We're waiting for Powell. The question now is, are we going to get the soft landing that central bankers always wanted to get? I mean, if we do see inflation dropping further, which I think we will, and equity markets kind of remaining stable, they will have done it somehow. Yeah. But you know, one thing at a time. Today is Powell, and I think that he will likely not be as dovish as the market expects. He has got reason to be dovish now. Slowly, you know, we got some pretty pretty bad data again. The ISMs and inflation is coming up on Thursday. They don't know this number yet, right? Do they? They don't know it yet.
No, I don't believe so. No.
You would think, but let's face it. Apart from the jobs numbers, everything else is not doing well. It's not good. So if Powell wants, he can use that. But I don't think he's going to go all out dovish yet, simply because inflation is still high. Yes, the trend is lower, but and I think it will continue. But for the moment, it's still at a pretty elevated level. We are expecting, what is it, 6? Hold on, let me check. What are we expecting this week? Thursday. Here we go. We're expecting CPI down from 7.1 to 6.5. So it's still historically pretty high levels, but the trend is lower. So I think the risk is still for him to disappoint the bulls, let's say, and be a little bit more on the hawkish side. But I think the pivot is coming pretty soon. So I am personally waiting for just that one final move where I can actually go in and short the dollar and getting a little bit more of metals and some risk assets perhaps. But for now, for today's Powell, this is the risk in my opinion.
Yeah, I think this might be one of these moments where a lot of people are going to be watching Powell and it's going to be a nothing burger. I mean, Kuroda's out now, finally speaking. He's talking about climate change and stuff like that. This is about central bank independence. So I'm thinking, it could be a bit of a dud in terms of getting some heavy monetary policy chatter. If that's the case, that still may bring a reaction if the market wants some stuff from him, but we shall see. Otherwise, it's gonna move quickly onto the CPI data coming up later in the week. I think that's pretty much reflected in prices at the moment. Yields not doing an awful lot. We've had the blowout already. Have just edging towards keeping around these lows that we've seen. 3.4 is a bit of an area to keep an eye on, but showing no signs of moving back up. The 2 years, back out the box, and this is a rough guide. But when we had all the stuff previously, we saw rates getting up the 2 years up to 4.5%. Fed being a bit more hawkish, that sort of thing. But still, we haven't been able to hold it. So for those who may not have followed the show before, we're looking at these 2 years as a rough rule of thumb over where the Fed ceiling might end up and what the market believes the Fed ceiling might end up looking like for the future, because the Fed have indicated they're going to get rates up this year and keep them high up into 2024. So the time horizon for the 2 year yield sort of works for that as I say, rough rule of thumb, but it's not looking like the market believes the Fed's going to be up at 5% and keeping them there for any significant period. Guys, what do you make of these yields? I mean, yeah, the CPI, if it comes in stronger than expected and doesn't dip as far as expected, we're probably going to see a rally in yields, a rally in the dollar again. And I'm still thinking those are moves we potentially want to be selling.
Agree with you 100%, and I think this is the risk now, because the market's gone so far one-sided, basically expecting the pivot coming and the Fed to be cutting in this year. I think the risk of the move is going to be a lot bigger if CPI surprises to the upside. So I agree with you. Having said all this, I agree with you. I think this will be, if we do see this move higher in yields, higher in the dollar, it will be, I think, our last chance to really get in front of it and sell into it.
Yeah,
that's what I think.
Great. Well, what do you make of it, Kate? I mean, dollar yen. I mean, I'm a bit gutted. Obviously, I was in shorts from 136, 135. I got knocked out on that move last week, 134.70. I still want to be short, but I don't want to short it here. Are we going to get a decent enough rally, do you think? What would cause that?
I think we could see a rally if CPI holds up. Personally, I don't think Powell is going to give us much, but of course his words are going to be dissected one by one by the markets, and we could see some algo moves on that. But as we were saying before, and I was saying already a couple of times, the market is still firmly in a dollar sell rally selling mode. We're seeing that on stuff like the euro dollar, cable as well, rallied over 3 big figures from its lows, and dollar yen came back. So the market is still trying to trade a slowdown, a recession, the rest of the central banks catching up on the Fed. A higher CPI should cause a blip, but then I think it's more going to be the stuff like other data going to be more longer-term drivers, because I quite agree with Stelios, and we've been saying that inflation for the time being has peaked and should probably go lower, but it's unless Fed pivots, I don't think it's going to be a very long-term negative for the dollar. It's all going to be about what the real economies are going to do in the end for me. But that's all like medium-term stuff. For now, yeah, the market's still in sell dollar rallies. On the yields fronts, if you take into account that they are going to do at least another 2 times 25 to bring it to 4 3/4, 5%, whether it be there's a 50 in it, or 3 times 25 to bring it to 5 1/4%. As I was saying last week, I think the market is more catching up on what the Fed is doing now, because the anticipation is ongoing, but in the longer end of the curve, I think the 2 years are much more going to follow what the Fed is doing, unless we get really out of whack numbers. Now, what the interesting thing for the dollar is that the rest of the yields outside of the US is also moving, and then if you look at, for instance, the differentials between the European rates and the dollar rates, they are continue to narrow. So that is also keeping the euro side bid, and I trust other yields are doing the same. But for the time being, I think yeah, the rally selling on the dollar is still very much in the market. But again, I'm having difficulties to see the long term of FX markets right now. So I'm really in a shorter term mode, and just right where the money wants to go. You know, there's some interesting, and it's tough to trade stuff like risk, for instance, right now, because the correlation with risk is not really there. Yesterday we should have seen the dollar rise a little bit, because the S&P, for instance, came back down from 39.5 to below 39, but nothing is moving. So you really have to go, and when the money moves, we should move as well.
Yeah, no, agreed. And I'm sitting here thinking, you know, one of the comments that Powell made previously was that he wanted to see real rates in the positive before they potentially look at slowing down hikes. You know, when we're certainly not there yet across the curve. You know, is that going to become a factor for him, and as part of the comments? Not necessarily for today, but maybe for the next FOMC or any other big appearance.
I think Powell will try to continue to steer us towards the 5% mark, and yeah, the easing financial conditions are not something that they particularly like, because but what else can they do if the market doesn't follow suit, and if the numbers outside of the labor market continue to be sluggish? They can't do much about the financial conditions for as long as the market is putting so much into the reserves basket, and not feeling any pinch credit-wise and things. I don't see where this takes us long or medium term. I don't know about the financial conditions, to be honest. What more can they do? Do more QT? I'm not sure that they want to do more QT to really steer us into a deep recession. So it's very unclear to me. But again, I'm not an economist. Maybe Stel has another opinion about that. But those financial conditions, if things get worse, I think the market will correct them automatically.
Cool. Stel, did you want to add anything to that? No.
He's gone surfing, mate.
He's gone surfing. Yeah, I don't blame him. Well, let's look at dollar yen, and it's sitting pretty much bang in the middle of the year's range so far. Coming in, we had that move down to the 129s, move back up to the 134s and a half, and a bit higher up towards that trend line. And we're bang in the middle now. I think that tells us the whole story of what the market's thinking at the moment. It doesn't know which way it wants to go right here and now. It's going to take its clues from potentially Powell today and the CPI later this week. And so the question always gets asked, if we get big data, if we get big comments, can we break out of these levels? If we can't, then that potentially starts showing us a decent range to trade between, and you potentially start leaning on the edges. Conversely, inside, we may get a little bit of a range inside, sort of 132s, 133s, down to the 131. So a range within a range for your short-term scalpers. That's what you got to look at really when the market is a bit undecided, bit imbalance, if you like. It doesn't know which way it wants to go. Just look for the ranges, play the edges, and look for the potential extensions thereafter. Euro dollar's looking quite interesting because we are making a break into 137, and we do have a very significant area up above in the 108s. This is a big level historically, going all the way back to 2015. I think it goes back even further than that to 2012, but it'll get a little bit blocky if I zoom out that far. But this 108, 30, 50, a very big zone. It's one I've traded plenty of times in the past when I've been in long-term euro dollar positions. It always seems to have a say in what goes on and can be quite significant. As I say, if you go back to the 2015s, you can see where we've had bounces of support, over several months, and it's gone 500 pips when it's bounced. Same thing when it's broken, it's gone again. So it is one of these watch levels that stick in the back of your mind when you're trading for as long as we do, and there's no reason to suggest it's not going to be a level when we get up to 108s again. Even last year it saw some action. So mark it on your charts as an area to keep an eye on, quite a big zone. Could be that it marks a significant top and we get a decent pullback from there, or we get a break and we kick on to 110, 112, 111, who knows. The next big level, just while we're on about it, is getting up to the 115s. It starts pretty much from 114, 114 and a half, another big historical level, but obviously a long way to go there. But if we get above there, those are the sort of areas we're potentially going to be targeting from there. Kay, you know this area well as well. I know you've played it plenty of times and watched it plenty of times. Likely to be a strong resistance area?
In the 108s?
Yeah.
Oh, definitely. It's one I'm really looking for the medium term. I've been saying it already a couple of times. It's to me, and it goes from 108 to high 108s, near to the 109 there. That's for the medium term. It's a massive area in my opinion. I can't say much more for the time being. What we're really seeing, and again, I'm repeating it, is euro process behaving pretty well, because despite all the let's take for instance the yen, all the yen buying, euro yen is still doing pretty well. Euro sterling had a quick blip under 88 yesterday, bounced quite rapidly. Even the Canadian on the Canadian labor report, I thought that really Canada was going to strengthen quite a bit. But then if you look at the EuroCat, we're higher than where we were ahead of the Canadian labor report. So all of that is telling me that the euro is still doing pretty well. So I would really not rule out a test of this 108, this 80, 90 pips zone, 108, 109. It should really be the big one, and I'm really not ruling out a test. Could be that just euro dollar is dragged up there through the crosses really, and the rest of the dollars perhaps not doing that well. I mean the rest of the currencies versus dollars. If you look, for instance, Aussie dollar has come back quite a bit. Kiwi couldn't hold 64. Cable can't hold 122 for now, but then the euro is still hanging in there, and that's what I mean when I'm saying like the crosses are influencing the dollar pair, and when I'm trading, I like really to look at those and get a feeling for what's going on. So if I want to be long dollars in current scenario, euro dollar is not going to be my pair of choice. It's rather going to be one that I feel a little weaker against euro as well. For instance, cable, or try to catch a knife in the dollar yen, because it seems to hold around 131, 30.50. So there's more interesting dollar pairs I reckon to look at than the euro dollar for now. But of course, the 108, 109, as you say, is a big zone.
Yeah, so it's maybe worth having a little quick chat about, you know, how you trade a level like this. You know, when you've got a bit of a zone, you know, when it's, you know, 10, 20, 30 pips, that's a different kettle of fish to trade. But when you got something that, you know, potentially might start from, you know, sort of 107, 70s, 80s, all the way through to maybe 109, even up to you know, 109.40, it's a big area to trade. Now, not everyone's going to want to trade over, you know, 80, 90 pips. So, you know, there's different ways you can go about it. If you want to take a more of a medium term approach, then what you can do is scale in against the levels. You know, if you break through 109.40, you know, you're likely, that's where your pain level is, that's where you're wrong. So you can either do small sizes, scale in, look to trade over a longer time frame, you know, maybe a few weeks, something like that, see what happens. Or you can get, you know, down and dirty, pick the smaller level. So maybe you can look at shorts, you know, 108.80, so 107.70, 80 into the big figure. If the big figure breaks, then look at the next level when you trade smaller pieces against each level with tighter stops. So there's different ways to skin the cat on this one. Given where we are now, I might look at sort of doing a bit of both. So doing a bit of short-term scalping and maybe leaving a bit on the books, take some profit on the trade, leave a bit on there just to see if for the longer term it becomes a decent resistance area. That way you can try and profit both ways. So you can nick the short stuff off the quick, you know, 20, 30 pips if the level holds, and keep a little bit on the books if it then goes and breaks after and goes through. So there's many ways to trade it, but you know, these levels are the types of levels you want to pay attention to. You know, it's one thing looking at a small shorter term level, you know, like in the 104.5s, that's one thing. But when you get these big levels, they can be really juicy. And if they hold significantly, you're talking 300, 400, 500 pips, even more. I mean, this was obviously a real out there move here after we broke it and we held coming back into the 108s and, you know, all the way down to 95s. Those types of moves don't happen often, but these sort of moves where you get, you know, 300, 400 pip rejections off a big area, those are the things, if you can catch them, very good for your balances. So several ways to trade these types of levels, but you always got to keep an eye on your risk. You are effectively going against the wind. This has been a real strong trend up. There's no real signs of it breaking at the moment. So on balance, you've got to think that the trend is your friend. So it is perhaps the way you trade is not to go too heavy on the risk if you want to trade this area, if you want to go against the flow, if you like. But as I say, when you get these levels, you in my opinion, you've got to give them a go. So how would you look to trade it, Kay? Short term, or would you put some in the slow cooker, as you like to call it?
Well, I've been saying that I've got I'm having trouble to make my slow cooker work right now, and the thing is it euro? Is it euro again? My question is it euro dollar that you want to trade? But let's say there's two main levels. Of course, you've got this trend line, but then you've got the horizontal as well, around 108.15, is it? So you can look at it in two ways. Either you trade off the 108.15. If it breaks, you could perhaps expect a move up to 109, which is the 50% of the really the FOMC pivot, right?
Yeah.
Going back to May, June 2021, coming from the 122 area. Yeah, that's the one. It's exactly the one I'm looking at as well. And the 50% is at 109. So you can trade 108.15 plus 109. You can trade a break of 108.15 and try to get it up to 109, for instance, with a very short term and tight stop if it comes there. If euro is still so strong on the crosses as well, for instance. But then you can on the other hand, yeah, you to me this whole zone is so important that scaling in a little bit on the other side, because the dollar isn't dead yet, for instance, but then you have to put your stop above 109 on a close. If you do it more medium term, you do it on a close. You don't go and if 109.05 goes beat, cut it all out, because you can run into other people's stop losses as well. Goes up to 109.25.
Yeah.
And then comes back down, which we have seen as well a number of times. So I'd watch that. If you do more medium term, I'd watch it on a close, this 109. Then the other thing is, depending on what comes out as data or what's happening on yields in the meantime, you can also go with a break, because if you really break, there could be three big figures above there. 112, for instance, is the next level. So yeah, there's really different ways to be trading that. For the time being, personally, from here, I can easily see it go and have a look into that zone. So I'm a little reluctant to start counter trading it from below 108, if you see what I mean.
Yeah.
That's the move. If we never get there, and we stop here and then we start to go back below 105, 104.5, yeah, then the party is over, in my opinion. But yeah, for the time being, I'd rather trade it on the shorter term. I could see some momentum trade if 108.15 breaks, and then you do another 85 points or so quite quickly. That would be a very short-term possibility, in my opinion.
Yeah, cool. Thanks.
But that's also because I'm a little biased right now on long euro crosses. That I see that it actually, per correlation, supports euro dollar as well, and then a bit of differential in there. But like, for instance, if you look at something else, if you look at I don't know, I mean, it's a big call, because people now are thinking that Bank of Japan is going to completely change tack as well. But I'd look at the 129.5, 130.5 is the same. It's the same level on the dollar yen than the 108, 109 in euro dollar, in my opinion. It's a big psychological zone, and it's been rejected. Yeah, I mean, take it down to 129. I think it's a bit the same thing, but if Kuroda is right in saying that this is only a technical whatever, and then we have to wait for another 3 months before knowing if the Japanese are going to get paid in April or not with higher wages, it could be a very big zone to lean against, and then have a look at that 134.5 again on the other side, 134.5, 135 on it's about the same, but I would rather do it in dollar yen right now than to do it on the euro dollar because of my bias on the euro process.
Yeah, got it. Thank you very much, mate. Well, I'll take a quick look at Aussie dollar before I hand it over to the K-Meister. This one, I'm losing a bit of conviction in. We've had one test of these prior highs that we were watching previously, or capped the rally previously. We had one look down to 86s, 85s, which could be classed as a hold, but I don't know that the PA isn't looking too hot for now. So I'm losing a bit of conviction of whether to try a long try here. If it does break through that 68.70 area, then potentially we're back in a box, and this is one of the Aussie's famous fake outs that it likes to do now and again. Suck everyone into a break and then spits everyone out again. That's part of the reason why I didn't go with a buy stops for a break of this one, because my conviction level is quite low. So I'm keeping an eye on that. I may still give it a go. I don't know. If I do, it'll be more small and short term, as opposed to trying to keep some in the pot for the longer term. But we'll see what the price action gives us on that. But it's looking a bit softer at the moment for now. Kay, I'll let you have a little look around the old grounds.
Yeah, it's going to be a quick one today.
No worries.
A really quick one today. What am I going to show you guys? Yeah, let's do a bit of dollar yen and euro yen and stuff. Here we go.
I'm going to shoot off, guys. I'll see you. I'll speak to you in the chat room, okay?
Oh, you're still here? We thought you shot off about 10 minutes ago, mate.
Yeah, nice. Thanks, guys. See you.
Okay, mate.
Yeah, this dollar yen, what I was saying there, we've got some more waiting here. Must be on the daily. Yeah, you see, this is the 129. This is a prior low, 130.5. We had this overshoot, which was the first day of the year when Japan wasn't even trading. So we quickly ran back above here. This is going to be a pretty important zone, in my opinion, on the dollar yen, if ever it would come down there. But for the time being, I'd rather trade this range, which is already. I need to go back onto a shorter term frame. In this 131.40, 131.55 zone, it's now holding. It seemingly wants to form a little bit of a base there. But of course, we could also say it's forming a triangle here. But I'd rather catch a knife in this one than the euro dollar, for instance, because of this. Of course, we are now hanging around this line. But if you look at the big drop, the euro yen really is putting in some performance in my opinion. So I've been trying to accompany this move now for a while, also because I'm seeing, and I'll show it to you, the short-term euro and US yield differentials narrow a little bit more. So I'd rather be on a euro, on the long side of the euro. This one I think could eventually come back into this 143 zone. That's what I would be looking at. This is going to be an important one, in my opinion. I'm not sure whether it can run higher because we've got the top here, bottoms here. But in the meantime, if there's not too much other news out from Japan, I can see this thing try to move back into this zone. Of course, if we get back under 140.5 right now, the party may be over. Cable. I was on the euro dollar, but I'm showing exact. I would show exactly what Ryan is showing really. But we did break this trend line. Since then we had a retest, and we're going back above. So I exactly have this 109 as well, the 50%, and then this trend line now, which had held prior, and then saw a big acceleration on the break, is now also around 109. But I would still respect those prior lows in the low 108s as well. The 108, call it 108.15-ish. That's going to be something that 107.85 here was the prior high. So this whole zone is going to be scrutinized, I think, by the market as well. But for the time being, I'm not really very warm in trading euro. For those who think that the dollar may not be dead yet, I think this is an interesting one on the cable just above 122. Seen it yesterday, rejected it a little bit. Also helped with the rebound in the euro sterling. I'm leaning against that one for now, but don't get overexcited. This morning's move lower already stalled on the 50% of this move. So just trade a bit of a range. I'm doing it as well. Bought some back what I sold last night. Bought some back this morning here. Don't get too greedy. This is a period where we're expecting more data, where we're expecting speakers. It's a time where you don't have to be too greedy. So I like to job it around and see what goes on. If it goes above 122, 1520, or 1525, I'm probably going to move out, and then but in the meantime, having traded it around, my risk is zero. Even I might even make a little bit of money, even if I get stopped out on the rest. Euro sterling yesterday, I was trying as we were doing the show. During the show, actually, it started to rebound. We're trying to get below here, but not even made it to the 87.60 next support, and we're back above 88. There's a bit of stuff going around. People are trying to look for inside patterns here, but I'd rather call it a range. I still like the hold of it. I'm still watching this one as a level of no return on the euro sterling. If it goes back below, my bias will throw it in the bin. But for as long as we're doing these kind of patterns, I'm just in the rinse and repeat program. Buy low, sell on the way up around, and keep a core long, and then see what happens. In the meantime, it's been given quite a few nice pips. What else? Aussie Kiwi, yeah. This flag seems to be at risk of breaking down a little bit. I think one and all has to do with what China is trying to come up with. Yes, they are trying to be very kind to Australia, which had supported the Aussie for a while, but then cutting the visas for Japanese and South Korean visitors is not really of the likes of the market, and this looks to be losing a bit steam. I'm really very small in it. I think but I think there may be better levels around 107, somewhere 107.1040. Could be a really nice zone to try and catch the next leg up. In the meantime, I'm really keeping it tiny and not doing too much in it. What else? For today, there's not too much else to show really. Just this one, dollar max is just continuing to slip and slide. We're trading around the lows. If we start to tackle those, whoops, what is this? If we start to tackle those prior lows that we've seen here around 1905, there could be more in store. Thinking, if you look at the whole move higher from 2013, we can see that this 1890 is going to be a pretty important level as well. So why not go and have a test of it? Mexican peso is still benefiting from its 10% interest rate status. Yesterday we had this rally back up to the trend line in the Euromex, and it stalled there as well in the 2060s. So that's an interesting zone to keep an eye on right now. In the meantime, if you are a fan of carry trades, this is still giving you a very good carry. So why not continue to try and benefit from this and for as long as those levels are capping. Metals have really been very quiet. Silver is still lagging, still disappointing somewhere. So I wouldn't rule out a test back of the low 23s. Still keeping the 24.5 in mind. In the meantime, gold is doing better. It's better. It's consolidating around the highs. Not even going to test the 1860. 1860 is going to be the first level to keep an eye on. So that's what I'm looking at. And then on the top side, of course, if we continue to push through 1900 magic level, if that breaks, then we could be in for another 3 or 4% move. And with that, Ryan, I'm going to give it back to you.
Thank you very much, sir. Gavin was looking at Aussie yen. Let's have a quick butchers at that. Funny enough, I've got one of my old lines sitting there as well at 90-80-ish. Yeah, it's looking a bit similar to what Aussie was doing. You know, trying to get above there, 91s, having a couple of goes, then getting above it, and now it's looking like the air's coming out the tyres. So pretty similar to Aussie dollar. If it goes back under this 90-80, you know, probably call it down to the 60-50 as a bit of a clearance. Then yeah, we're potentially going to see more of the rally dissipate in this one as well, and then be looking at where your support areas is coming in to that sort of 90 area, 90-80 or 89-80, around that sort of area. Yeah, I've not got much more to add to things. What I will do is give you guys a little bit of a pump and a heads up for our traders funding program. For those that may not know about it, if you want to trade the ForexAnalytix money instead of your own, have a look at that. It's particularly good for traders in the US because it's not subject to FIFO rules. So you can go long, go short, cut positions, get in and out as a luxury that we get to do this side of the pond, that you guys can't get to do there in the US. Your risk is really only the assessment fee. So you know, if you get in, make money, take money out, great. If you happen to blow up the account for any particular reason, or you struggle in the first instance, your risk is just the evaluation fee. You are not liable for any losses on the account, even in black swan events. You get to keep 75% of the profits, and you get free access to the ForexAnalytix platform, which is worth double the money alone, I can tell you. So as you can see from the comments, Brand's been in the program, as have several others, and we've got more of you guys joining this January as well, looking to kickstart your year on the right foot. If you do need any questions answered about the program, if you're in the chat room, there's a dedicated room, or you can use that intercom button down the bottom to ask any questions, or ask any of us anywhere at all, and we'll be glad to help and make sure you get the right support needed to become successful. So have a look at that, the information, and if you like it, sign up and give it a crack. And on that note, we shall call it a day. Thank you to the already departed Stel. I shall say thank you in the background. Thanks, Kay, and we'll see you guys all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.